Hello again. Now we are going to go through a series of slides and cover all the important topics and the points so that you have a solid understanding of all the topics, the industry, the fund setup structure, the investment process, reporting, accounting, all of that. So once again, who is this master series for? As we have said that this master series is right for you if you are looking for a job in this industry, you are looking to set up a fund and would like to know more, and also if you want to expand your knowledge. Now, in terms of what you need to know to be able to participate in this master series is that, of course, you need to have a background in accounting if you are looking for a job as an accountant. But other than that, there is no real formal education is needed, and some background is of course very welcome. And but if you don't have it, it's also okay. And this is one question that everyone asks me, is that there are so many other classes out there, so why should I take this master series? Now, I have done my research and I have actually looked at hundreds of courses out there, and let me assure you that I have not even found one that resembles this master series. Most of them are taught by academics, and they teach you to be an investment manager. Our master series is actually taught by experts, real experts with real life experience, and our focus is to either to help you get a job or help you set up a fund. So these are the real life professionals that are teaching it. And also the other thing is that if you are looking for a job, we can also give you some interview tips to get into this industry, and also hopefully connect you with some resources. And if you are a fund manager, then of course we would love to connect you to the service provider so that it really becomes a simple process for you. Okay, so what are the topics that we're going to cover through this? There's a lot of it, so let me just go through it. And as we have said that this is a one-stop shop, so we have done a lot of research and we are going to cover a lot of issues and a lot of points so that you know as much as we do once you are done watching these videos. So yeah, so these are all the topics that we're going to go through, as you can see. And I'm not going to repeat that, but by the time you are done watching the videos, you learn about all this. Continued. Okay, so now that we have just gone through that introduction, let us start our module 1. And this is a very basic overview that we're going to start with. And then as we progress, it will become more and more complicated. Okay, so let's start with the history of fund. And you may or may not already know this, but it's worth repeating even if you do. So not many people know that the first fund, collective investment fund, was set up in 1772 in Netherlands, in Holland, to actually invest in sugar plantations. So it goes back a long way. And then later, the first modern day mutual fund was set up by Massachusetts Investor Trust in 1924. and the initial investment was only $50,000, but then it grew to almost $400,000 within a year. And this was an open-ended fund, by the way. Now, the first private equity fund was set up in 1901, and as you can see, now the real private equity fund was actually um, not set up until the end of the Second World War, and they would then invest in startup companies. So, in terms of the fund, the different type of fund products and their strategies. So let's go over that now. Now, I'm sure you know there are open-ended funds and then there are closed-end funds. Now, what is the open-ended fund? Open-ended funds are collective investment vehicles that take investments on a regular basis from investor, and they also allow redemption when investors ask for it or during regular regular cycle, regular redemption cycle. So typical hedge fund would invest in public securities or pre-IPO securities. Now the closed-end funds is what we're going to actually put all our attention in. Uh, and closed-end fund, the example would be a VC fund, as you have seen. So they would typically invest in early stage, high growth startup companies. And they are, of course, startup company, they could go belly up or they could become really valuable. Now, the private equity funds invest in private companies and they would typically take minority interest. Then the real estate funds. So they, of course, invest in real estates and properties, and uh, they would get rental income and coupons and all of that. Now comes infrastructure funds. Infrastructure funds are typically large government sponsored projects that they would participate in with the funds that are raised. So they would build roads, bridges, airports, like that. And then the debt funds. The debt funds would actually help high risk companies that maybe do not qualify for bank loans. They would provide credit at a higher interest rate. Now, now that you have seen the major types of the funds, the closed-end funds, now where are funds typically domiciled? Because this is a very important point, and a lot of it depend on your investors or the location, all of that. Many investors would have preference for a certain domicile, and also based on your investment, it may be actually better to domicile in a certain jurisdiction and not the other. So the world's number one domicile for private equity funds is Delaware in the United States. And even today, the most US private equity funds are domiciled there. And it's also the largest in the world. Now, the second, or another very popular and prominent domicile would be Cayman Islands. And if you are a fund manager in Asia, or if you are an accountant in Asia, it's highly likely that your fund would be domiciled in the Cayman Islands. Luxembourg is the I believe now it's the second largest domicile in the world for funds. It's huge. And since the introduction of AIFMD, or as it is known as an European passport, Luxembourg has become increasingly popular. And of course, some of the very traditional and large funds also are domiciled in the Channel Islands. And I'm sure you know that they have two islands. So there is Jersey and then Guernsey. Now, for Asian investors, and this is fairly recent, is that Singapore and Hong Kong are becoming quite popular as fund domiciles. And both Singapore and Hong Kong has special incentives and also requirements to be able to domicile in those jurisdictions. And we're going to cover that in more detail later. Okay. Now let's talk about structuring a bit. So in general, typically a private equity fund would be set up as a limited partnership. And when you set up a limited partnership, the investors are called limited partners. Now the fund manager would be called as a general partner or GP, and he or she would be responsible for all aspects of operation and then decision making for the fund, including the setup and the fundraising, all of that. And with the private equity fund, the GP would almost always have an investment advisory agreement with the fund. And typically, these are all set up in tax favored jurisdictions. And as we mentioned before, that it'll really vary based on the sector and based on the geography. And then if there are more than one investments in a fund, then they may even be set up in several jurisdictions and not just one. Now, in terms of the life cycle of a fund, it's actually quite long. It's between 8 to 10 years. And even within that, those limited partnerships can be in more than one jurisdictions, and also there may be some additional feeder funds underneath the main fund to meet the demand of particular investors. And in terms of strategies, there are some private equity funds that would say, you know what, I'm going to invest in any project that I find attractive. Or there may be some managers who would say, you know what, I'm going to focus in this industry, or I'm going to focus only in Southeast Asia. So it all depends based on the preference of the manager. Now, who invests in private equity funds? Because you cannot really leave until the fund is divested. So the typical investors would be a pension fund, there would be a sovereign wealth fund, endowments, or really high net worth individuals that would not need their investment back until the fund is actually closed. So this is an example just to show you how a US type fund is structured. Okay, so now the question is that what is the incentive of a GP / fund manager as they set up a fund, and how do they make money? So how they make money is through two ways. Number one is the management fee. And the management fee is to cover all the expenses of of setting up fund and then also the ongoing expenses of running the fund. So that would include salaries and rents. But the more lucrative portion of the manager's pay is through divestiture of assets, what you would call them, you would call carried interest. So when a fund divests its investment, a portion of it actually goes to the GP. So that is the main attraction of being a fund manager. And then uh, typically a GP would receive about 20% of the profit of, from the fund. Okay, so now let's go through the fundraising process. And many people do not know, but the fundraising process can go from 12 to 18 months. So it's a really long process. And so the fund manager or the GP that wants to set up a private equity fund, he or she needs to be patient and just go through this. Now, when a process starts with it's the initial marketing period where the GP would talk to his contacts or her contacts and they prepare a business plan, pitch book, marketing material, and start to hire placement agents. Then comes the setup stage. And during the setup stage, the manager would typically appoint all the service providers. So this is the tax experts, law firms, advisors, and also prepare the limited partnership agreements, documentation. Then comes the launch stage, and during this process, the it really becomes official. It starts to take shape. So the GP would do all the filings with the regulatory bodies, and then he or she would finalize the fund documents and then also start active marketing. Now, the next phase, the GP would engage in discussions with investors and start negotiating with them the agreement, the side letter. Oh, I should actually explain what a side letter is. So, a side letter is if some particular investors would ask for something special that is not part of LPA, then you would create a side letter to accommodate that investors. And typically, that would probably go to more prominent investors with higher level of investments within a fund. Okay. So, and this is also where all the decisions are made if there should be a feeder fund to meet the demand of some particular investor or not. Okay. So then comes the initial closing period, and you have already received all the commitments from the investors. You have found all the investors. You have signed all the documents. Then you close the fund, and by that time the investors have already promised to make investment uh, with an amount that is committed, but it's not given yet to the investment manager. So once the initial closing is done, so then everyone has an allocation in the fund, and then once that is done, there may be more closing. So if you have a new investor coming in, then you would set up more closings, additional, maybe the second closing or even the third closings. And at that time, there would be final closing and no more money will be accepted. Then comes the actual investment process, drawdown process, and all of that. So now we're going to go through that. Okay. So this is something that I have already said. That okay. So this is the thing. The fundraising process in its entirety takes 12 to 18 months. So it's a long process. So the investors, the manager or managers would have to have patience and just take the time and then go through the process. Okay. Now comes the closings and equalization. So once the closings are done, then comes the drawdown. So what drawdown is that these are just notices sent to the LP or investors to ask them to send money based on their allocation. So this money is sent to cover GP's management fees, all the expenses, or for investment. So if there is an investment that is identified, then there would be drawdown notices sent to all investors, and then they would send the funds based on their allocation in the main private equity fund. Okay. And what equalization is that once the first closing is done, then everyone has an allocation, right? So if there is a new investor coming in, so then that person would also need to be allocated, and and they also have to make investments. So then what happens is that the portfolio is rebalanced to make sure that the later investors have contributed fairly or proportionately for all the previous drawdown. So this is just a method where the portfolio allocations are rebalanced so that it's fair to everyone. Okay. Now comes the fund life cycle. So there is the investment stage once the fund is closed, and then that would typically take from year 1 to about year 4 to 5. That is when the capital has been drawn down with drawdown notices, and then also the investments are made. So it can be an initial investment in one firm with with follow-up investments in that firm as well. So it really depends based on the GP. And then once that is done comes the growth stage. And what growth stage is that those are the years when the GP either himself or through his team or outside advisors would actually get involved in the portfolio companies. So they would monitor the performance, help the management, and increase the value of the company. And if there are any investments that are already mature, it's at this stage when it would go through the exit, and then the cash will be distributed to the investors and also the GP. The maturity stage is typically year 8 when all the investments have been divested. So everything has been sold, and then the investors would get their investment back and also the profit. Okay, so during these during the investment stage, the year 1 to 5, so that's when all the investments are made. And when a GP makes an investor, it's actually quite complicated process. So they would do a lot of due, due diligence. They would visit the companies they want to invest. They would meet with the founders and the management team, and then they would make a decision. So all these things happen from year 1 to 5. Okay. Now, during the growth stage, as we said, then GPs would focus on the growth of the company. Yes. So this is at the divestiture stage on year 8 is when all the investments have been returned with the profit, and also the GP would receive his carried interest, the profit. And typically the way it is calculated is by using this method called waterfall logic. And this is how investors would get paid, and then the GP would get paid. So there is a formal process to it that we're going to go through on the subsequent slides. Okay. Now, what is a carried interest? Carried interest is a payment to the GP out of the profits earned by the fund. And LPs, the limited partners, would get the rest of the profit. So typically, as we said, that a GP would get about 20%, and rest would go to the LPs. And so they also vary depending on the type of the fund. So if it's a VC fund, if it's a venture capital fund, then a GP would get between 20 to 30%. But if it's a more stable, larger fund, then it's typically less. It's between 10 to 15%. I mean, the logic behind it is that a GP would spend a lot more time working with the management at a VC fund. But for mature fund in other industries, it's not as much time. Now for US funds, so in terms of the distribution, so for US funds, they do it deal by deal. So like for example, if you make 5 investments and then you have sold one, you would make a distribution on that fund, and then you'd pay it out. Now for European funds and also the funds that are prevalent in Asia, it's the life cycle of the fund. So you may have 5 investments, and if you sell one or two, then you are not going to pay out at that point. You would actually wait for the entire 8 years until you do the formal divestiture, and then you would pay out to the investors, and also pay the carried interest to the GPs. Okay, so this is one of the extremely necessary process when a fund manager set up a fund is the uh, KYC process for investors, and also the fund uh, corporate investors. So this is individual and corporate. Now the general guideline is that for individual investors, a valid passport with photograph, name, date of birth, and nationality, and that would need to be certified by proper authorities. And then a proof of address. So it's proof of residential address. So it can be a utility bill or a bank statement within the last 3 months or so. And this is something that is also done for many funds where the source of fund for investments needs to be provided. And so, but then if you are a corporate investor, or if you are accepting a corporate investor, the threshold is actually much higher. And if the investor is from a regulated entity, then you'd ask for all of these documents. So this is the certificate of incorporation. This, if you are listed, if you are regulated, then you need all those documents. You need a list of the directors of the fund, board resolution authorizing the investment, and then also authorize signature list. And for all the authorized people that interact with the fund, you need valid passports with photograph, name, date of birth, and nationality. Now, now comes the fun part where uh, on a regular basis, the investors expect certain reports to be done, and the fund operation people slash accountants would prepare this. So number one is the annual audit report. So this is universally required and prepared by the fund to make sure that the you know the all the transactions have been recorded properly. And the fund also prepares a quarterly financial statement, and it's typically usually about 45 days after the quarter end. And then of course there is quarterly reports to the investors, telling them how the fund is doing, how the activity is going, and how each of the investments are doing. Then comes the quarterly capital account statement, which is important. And if there are US investors in a fund, then there is a K1 that needs to be prepared as well. So that's pretty much in a nutshell at high level. And now we are going to go through all this or most of this in a lot more details. And as we have said, we have invited a group of experts. So there is uh, you're going to hear from lawyers, fund accountants, fund administrators, and also fund managers on real life experience and the topic. So with that, that is the end of module one, and thank you for listening and watching. So, and we will see you very, very soon.